Right, risk management framework. So an imperative in any bank is a fit-for-purpose risk management framework, which itself would incorporate the risk appetite framework and the risk appetite statement. Both these documents, let's just say the risk appetite framework is within the risk management framework. This document is subject to close scrutiny by the regulator in a way that wasn't the case 5 or 10 years ago. This is meant to be a board-approved risk management framework, so the document, the framework itself, will come under close scrutiny by the regulator. The aim of the RMF is to ensure a standardized and unified approach to risk management practice throughout the bank, and indeed, if it's a group entity, in every entity in the group and across legal and regulatory jurisdictions for a group entity. So what we're going to describe in the next few slides is a template risk management framework in summary form, a summary of a risk management framework that would be applicable to a hypothetical but orthodox commercial banking operation. Okay, so we're going to describe in summary form a template RMF that we think could translate quite effectively over across to a real world vanilla commercial bank. So let's kick off there. First of all, risk strategy. Sound risk management is at the heart of the bank's strategic objectives, both as an end in itself and to facilitate the achievement of the bank's business strategic objectives. The ultimate aim is to protect the bank's long-term viability, and that includes making sure one is producing sustainable revenue streams over the long term. Risk management isn't just about mitigating risk exposure. It's also about ensuring balance sheet viability through the P&L stream. You don't have continuous minimum target or minimum required profit, net profit, then you're not going to have a viable business model for too long. Bank strategy is to concentrate on customer lending and deposit taking. We say this because this is a hypothetical commercial bank that we're describing. So its main business is going to be customer lending and customer deposit taking. And also we place this framework, or we describe the risk management framework within the higher level framework of the 3 lines of defense. So that is also part of this risk management framework, the 3 lines of defense framework, which is not new. It's been around for, I would suggest, at least 20 years. The board's risk strategy is reflected in its risk appetite statement, and this is supported by a set of appropriate key risk indicators and early warning indicators. And I'm going to look at those later on this evening. Okay, let's have a look at a high-level summary of the framework itself. And there you go, the blue boxes. At the top, we've got the governance operating model, the governance structure of the bank. So that's from the board of directors downwards. And flowing on from that, so in other words, the board of directors are responsible for and approve this risk management framework. Flowing down from that, we have the bank's strategy and its business plans. Flowing down from that, we have what I've called there the high-level risk taxonomy, or you could call it a risk register. At Royal Bank of Scotland, we used to call it the material integrated risk assessment. That's basically the description of all the risk types that the bank is managing. And then you've got the risk appetite following on from that. That is a qualitative and a quantitative statement of the bank's appetite for each of the types of risks that it's identified exist and which it needs to manage. All right. Then you've got the actual risk appetite statement itself, the actual quantitative limits. Then following on from that, we've got policy documents, procedures, and processes. That's how a risk management framework essentially might be described. And different banks do this in slightly different ways. You'll see this illustration here in slightly different ways